Have you ever wondered what people actually mean when they say, just put your money in a fund and let it grow? Words like index funds, mutual funds, hedge funds, and ETFs get thrown around constantly. But almost nobody stops to explain what they really are, how they work, and more importantly, which one might actually make sense for you. So today, let's slow down and break all of this apart piece by piece in a way that actually makes sense. Stick with me for the next 15 minutes and you'll walk away understanding something that took most investors years to figure out. And before we go any further, a quick disclaimer. Nothing here is financial advice. This is purely for education, so you can make smarter decisions with your own research and your own judgment. Let's start from the very beginning. What exactly is a fund? Picture this. You and a group of neighbors decide to build a community garden. Instead of one person buying all the seeds, tools, soil, and fencing alone, everyone chips in a small amount of money. With that shared pool, you can afford things that would have been difficult for any single person to manage alone. Nobody has to carry the entire weight, and everyone still gets to enjoy the harvest. That is essentially what a fund does with money. A large group of people combine their savings into one pool, and that pool is used to buy a mix of investments, things like company shares, government or corporate bonds, or property. Instead of each person having to research and manage every single investment on their own, the fund does that work for them. And everyone who contributed shares in the outcome, whether that outcome is growth or loss. Now that the basic idea is clear, let's talk about the first and probably most talked about type, the index fund. If you spend any time on social media around personal finance, you've probably heard someone say something like, just buy an index fund and forget about it. But what does that actually mean in practice? An index fund is built on a very different philosophy compared to most other investments. Instead of trying to guess which companies will perform best, it simply mirrors a list of companies that already exists, known as an index. Think of an index as a kind of sample or scoreboard. It's a curated list meant to represent a slice of the overall market. The most famous example is a collection of 500 of the largest and most established companies in the United States. When people say, the market went up today, they are very often referring to this exact index. The bigger a company is within that index, the more influence it has on the overall number. But that's just one example. There are indexes built around all kinds of themes. Some focus heavily on technology companies, home to giants that have driven massive growth over the last decade because of the rise of digital products and services. Others are built around a smaller group of long-standing, well-known companies across completely different industries, from beverages to aerospace to consumer goods. And beyond that, there are indexes for smaller companies, for international markets, for developing economies, and even for specific industries like energy or healthcare. The pattern across all of them is the same. No guessing, no hand-picking. A computer-like formula tracks the list, and the fund simply follows along. Because there's no team of analysts trying to outsmart the market, index funds are described as passively managed. Nobody is actively deciding what to buy or sell day to day. And this passive approach turns out to be a huge advantage, mainly because it keeps costs incredibly low. You're not paying a team of experts to make guesses. You're paying for a system that quietly does its job in the background. Most index funds charge an annual fee, often called an expense ratio, that can be as low as a couple of hundredths of a percent, and rarely goes above 0.1%. To put that in perspective, if you had $1,000 invested, you might pay somewhere between 20 cents and $2 a year in fees. That's remarkably cheap compared to almost any other financial product. Some of the largest companies offering these kinds of funds are well-known names in the finance world, firms that manage trillions of dollars across index-based products. Because your money is automatically spread across hundreds of different companies at once, index funds also tend to carry relatively lower risk. If one company inside the index has a terrible year, it usually won't sink your entire investment, since it's just one small piece of a much bigger picture. There is one important detail worth understanding here, especially if you're new to this. Unlike buying a single stock, you can't just click buy on an index fund and lock in whatever price you see on your screen at that exact second. Index funds are priced only once per day after the market has closed. That single daily price is known as the net asset value. It's calculated by adding up the total value of everything the fund owns, subtracting any expenses, and dividing that number by the total number of shares in the fund. So if you place an order in the middle of the trading day, your transaction doesn't happen instantly. It gets processed using that end-of-day price once the market closes. If your order comes in before a certain cutoff time, it typically gets executed that same day. This system makes things simple and predictable, but it also means you give up the ability to time your entry down to the exact minute. For most long-term investors, this barely matters, but it's worth knowing so you're not caught off guard. So why have index funds become so popular? The answer really comes down to three things. They're inexpensive, they require almost no effort once you've bought in, and historically, they've performed quite well over long stretches of time. Even some of the most respected names in investing have publicly recommended this approach for the average person, largely because consistently beating the overall market year after year turns out to be extraordinarily difficult, even for professionals. Now let's shift to mutual funds, which on the surface look similar to index funds. Both pool money from many different investors and spread it across a variety of assets. But the key difference lies in how they're managed. While index funds passively follow a list, mutual funds are usually actively managed. That means there's a professional, or sometimes an entire team, making deliberate decisions about what to buy, what to sell, and when, all with the goal of outperforming a benchmark like that same well-known market index. That sounds appealing in theory. Who wouldn't want a skilled expert working to beat the market on your behalf? But here's the catch. Active management comes at a cost. Because you're paying for research, analysis, and decision-making, mutual fund fees are noticeably higher than index fund fees, often somewhere between 0.5% and 1.5% annually, and sometimes even more. And the uncomfortable truth, backed by years of data, is that most actively managed funds don't consistently beat the market over the long run. Some years they win, some years they lose, but sustaining outperformance year after year is rare. Still, plenty of people choose mutual funds anyway. Maybe they trust a particular manager's track record, or they want targeted exposure to a specific industry, country, or type of asset that isn't easily available through a simple index fund. It can also serve as another layer of diversification within a broader portfolio. Several of the biggest names in the fund industry offer both actively managed and passively managed options. So it's worth checking exactly what kind of fund you're putting your money into before committing. And just like index funds, mutual fund orders are also processed at the end of the trading day based on that same kind of end-of-day pricing. Next, let's talk about something completely different in both structure and mindset: hedge funds. The word hedge originally referred to reducing risk, but in practice, most modern hedge funds are far more focused on chasing higher returns using aggressive and often complex strategies. So, what exactly is a hedge fund? It's a private investment vehicle that pools money from wealthy individuals or large institutions and invests across a wide range of assets, everything from stocks and bonds to real estate, currencies, and complicated financial instruments called derivatives. Unlike index funds or mutual funds, hedge funds frequently use techniques like short selling, which is essentially betting that a price will fall, and leverage, which means borrowing money to increase the size of their bets. These strategies can amplify gains dramatically, but they can just as easily amplify losses. Hedge funds are actively managed, usually by managers who have significant freedom to make bold, unconventional moves that a traditional fund manager might avoid. Because the risks involved are so much greater, hedge funds are typically restricted to accredited investors, essentially people who already have a high income or a high net worth and are considered financially equipped to absorb potential losses. And then there's the fee structure, which is famous in finance circles. It's often called the 2 and 20 model, a flat 2% annual management fee, plus 20% of whatever profits the fund generates. That's a substantially higher cost than what you'd pay with an index or mutual fund. To justify those fees, hedge funds aim for much higher returns, but that ambition comes hand in hand with much higher volatility and risk. Finally, let's talk about ETFs, or exchange-traded funds. These are often described as a hybrid between an index fund and an individual stock, and that description fits well. Just like a stock, an ETF trades throughout the entire trading day on a stock exchange. But just like an index fund, it provides built-in diversification by holding a basket of different assets inside a single fund. Because ETFs trade throughout the day, you can watch their price move in real time and choose exactly when to buy or sell based on current market conditions, giving you a level of flexibility that traditional index or mutual funds simply don't offer. On top of that flexibility, ETFs also tend to carry low fees, generally even lower than actively managed mutual funds, often ranging from a few hundredths of a percent up to around 0.75%, depending on the specific fund and how it's managed. Since most ETFs are passively managed and built to track a particular index, sector, or segment of the market, they function very similarly to index funds in spirit, just with the added benefit of real-time trading. In fact, if you wanted exposure to that same well-known collection of 500 major companies we talked about earlier, you could get that exposure through either a traditional index fund or an ETF that tracks the same list. Many brokerage platforms also let you buy ETFs without paying any trading commission, which makes them extremely accessible, even for someone just starting out with a small amount of money. So, bringing all of this together, how should you think about these 4 options? For most everyday investors, index funds and ETFs tend to be the most practical choice. They're low cost, relatively easy to understand, and offer broad diversification, which makes them well suited for long-term investing without requiring constant attention. Mutual funds can make sense if you have strong confidence in a specific manager's strategy, or if you want exposure to a niche sector that isn't easily accessible otherwise, but you have to accept higher fees and less predictable performance in exchange. And hedge funds exist in a completely different world, designed for high net worth individuals who are comfortable taking on significant risk and paying premium fees in pursuit of potentially higher rewards. They're simply not built with the average investor in mind. Understanding these differences doesn't just help you sound smarter at a dinner party. It genuinely changes how you approach your own financial decisions. Because once you know what you're actually paying for and what risks you're actually taking on, you're in a much better position to choose what fits your own goals. If this helped clarify things for you, that's really the whole point of putting this together. Take some time to think about where your own money sits within these categories and what might make sense for your own situation going forward. Thanks for watching, and I'll see you in the next one.